My name is Pascale Leroueil. I'm the Vice President of the Healthcare Initiative at the William Davidson Institute. And today I have with me Tom Light, who's the Managing Director of WaterEquity. Welcome, Tom.
Thank you.
So, Tom, what was the genesis of WaterEquity? What problem was it trying to solve?
Yeah, WaterEquity is the first ever impact investment fund manager with an exclusive focus on solving the global water and sanitation crisis. And so, not to get too much into details, but the global water and sanitation crisis, the statistics I usually cite are 1 in 3 people lack access to a toilet or sanitation facility, and about 750 million people don't have access to clean water. So that's the problem that we're trying to solve through private sector solutions, and it's disproportionately hits developing countries, the poorest of the poor, and women and children, who obviously wake up in the morning scavenging for clean water every day.
So can you describe how operationally this works? So you have your WaterEquity, you have your investors, you have your private sector, your financial institutions and the beneficiaries. How do those all interact?
Yeah, I think when people hear that we're an impact investment fund manager, they sometimes think that maybe we work differently than a typical asset manager. We don't. We position ourselves as an institutional quality asset manager that has a social focus. I think that, so the answer is exactly the same as any Wall Street firm would interact. The difference probably is that our cost structure is a lot higher, right? I mean, if we were based in Ann Arbor and we were investing in businesses like in the surrounding area, it would be a short drive, right? Yeah. We have to invest in broken markets on the other side of the planet, where the cost of doing business is usually a little bit higher. So I think in terms of our cost structure, it's probably higher than the normal typical investment management firm. And then there's the additional cost of all impacts have investment. All investments have impact is something that I hear a lot. But impact investments are focused on intentionality. Like, we're focused on actually counting the number of people that we can end the global water and sanitation crisis for. And so there's the additional layer of not just generating a financial return, but a social return. And so those are additional challenges that we have.
Right,
yeah.
Right. So going back to your investors, my understanding is that your business model relies on something called blended finance. Can you tell me a little bit about that and what that means in terms of returns?
Yeah. I am a huge fan of blended finance and WaterEquity. I would say of the impact investment firms that are out there that are launching funds, and this is just what I've seen, I haven't read this, but I would say less than 5% are utilizing blended finance in my experience. And blended finance is not a term that's used to describe how you make investments. It's how you raise capital and pool capital. And it's simply the fact that as an asset manager, we're taking concessionary capital from some investors to crowd in private sector investment, right? And so an example of that would be, maybe the simplest example I could use is that for our second fund, which was closed in November, which is the $50 million fund, we took our proprietary capital, our own money, and we wrote a $5 million guarantee, right? And that guarantee is serving as a credit enhancement to the more institutional-like investors that want to participate in the fund. And that's an example of kind of a form of a subsidy, right? Because we're writing a $5 million guarantee that could be drawn upon if there were losses in the fund. And that enables the private sector to kind of feel a little bit more comfortable about making an investment in the frontier markets that we're investing in. Now, with time, blended finance will eventually go away once you can deliver a risk-adjusted market rate of return, right? And so we expect that to kind of go down and down and down as we launch funds.
Right, so that actually goes to my next question, is that your expected returns are below that market risk-adjusted rate. And so how does that square with this big selling point of yours, which is financial sustainability?
Well, I mean, there's sustainability of the fund manager is basically how do I pay my staff, right? Which is, we'll have to get at least, I think generally when I speak to asset managers that are comparable or like-minded to us, it's usually about $250 million in assets under management. You multiply that by a 2% management fee, which is very generous, 2% management fee, and you get to a point of financial sustainability. We're not there yet. We currently are a US-based asset manager with about $60, $70 million under management. So we're looking at the next fund that we're going to start marketing next year at kind of stepping towards complete financial sustainability. But in terms of the funds, I think, and I think that's from the fund manager perspective. And from the fund structure perspective, I think it depends upon the market, right? There's a lot of investors right now, I think family offices, smart philanthropy that's being driven from the largest foundations. The Ford Foundation, which is located nearby, is now taking their endowment and trying to match it towards impact investing as well. And those types of organizations have come to the realization, I think, that charity isn't scalable. And they're carving out more of their instead of, in lieu of giving grants, they're now making program-related investments into funds. So it could happen, and we don't know, we'll follow the market in this perspective because we're agnostic in terms of how we want to pool capital. It could be that a lot more foundations start making investments in impact investment funds. And so if that happens, we might continue with blended finance 5 years from now. So let's see.
So looking forward, so 10, 15 years down the road, where do you see water equity playing? Do you see it expanding outside of water and sanitation? Do you see it going away because capital just becomes available in those markets?
I'm an optimist, and I think optimists, sometimes they're wrong, but pessimists, pessimism is all self-fulfilling, right? So water equity as an institution, this is a problem that's solvable within our lifetimes. We already solved it, in the United States and other developed countries. So it's not rocket science in that regard. I think the solution is that within our lifetimes, once we can start providing affordable capital to these businesses in developed markets and frontier markets, and they start serving the poor, and the local businesses see that there's an investment opportunity there, there's a bankable investment opportunity there, there won't be a need for water equity to exist, right? I think what will eventually happen will be there'll be local investment funds in India or Cambodia or Sub-Saharan Africa that basically do our job, right. And they'll have a lower cost structure because obviously our salaries are a little bit higher here in the U.S. And then at that time, after we innovate ourselves out of a job, we'll have to think of what the next challenge is, right. I guess. But we're not an organization that wants to exist into perpetuity. But I would say that's the first answer. That's kind of the 15-year answer. In terms of the 8-year answer, water equity has to very quickly put hundreds of millions of dollars under management, right. Before we can move the needle, and that occurs. And so I'd say in terms of the 5-year plan, 5 years from now, I hope we're speaking and we have 500 million or more under management, right?
So finally, you're from the private sector. So what do you think is the biggest advantage of having that private sector grounding and entering this space, which is probably a bit different than what you were used to?
Yeah, I stumbled into this space, right? I came from the typical, I graduated from the University of Michigan, thank you for the education, with a degree in quantitative economics. Then I went to Wall Street, investment banking, and I spent basically 18 years cumulatively in the investment management industry. And then jumped over to the social sector, the nonprofit sector, maybe I call it the social sector, with the Clinton Health Access Initiative, and kind of found out that my skill set and all those investment management skills were a great match for this burgeoning kind of emerging market, which is what we call impact investing. And so I kind of went in there and I'm trying to help build this market. Mm-hmm. In my experience, my advice is I have a lot of people that are interested in what we do and they want to contribute and they're willing to do everything, but I always say I want people to do what they're good at. Right. And I feel that when I graduated, for me at least, I benefited immensely by going straight to the private sector. It invested in me in a way that I think the nonprofit sector cannot, mm-hmm. and it gave me highly transferable skills. Mm-hmm. Now, I do think that if you stay in the private sector for maybe, there's a point, maybe over 20 years or 25 years, you start to get so specialized that the move over to the social sector becomes difficult. But I usually recommend that graduates go into the private sector right after graduation. Not everybody says, I've heard people give different advice on that though, so.
Right. Wonderful. Yeah. Thank you so much for joining us, Tom. It was really great to hear what you're working on. Thank you so much.
Thank you. No, it's a pleasure to be here at William Davidson Institute.